all of you and welcome to this free webinar today that we have on the topic insurance for beginners. I welcome you on behalf of IRA Coaching. My name is Radhika and I'm one of the teaching faculties at IRA Coaching. I have served in the insurance industry for more than 30 years. And IRA Coaching is a team of subject matter experts who try and bring whatever knowledge that we have gained from the industry to freshers and beginners like you. So we welcome you to this webinar and I hope you will make much use of this. And so as I can see from your registration forms, most of you are beginners and totally freshers, early insurance professionals. So we look at some of the fundamental concepts of insurance and what is risk all about, how is insurance, practiced, what is the significant fundamental framework in which insurance operates across the world. That is what we look at today. And this is a free webinar which will run for the next 30 minutes. I would request you to pay attention and be with me. In case you have any questions, you can put it in the chat box. I'll be more than willing to answer you. Right now, we'll get started. So some of the key terminologies when we talk about insurance, of course, insurance itself is a wholly loaded word which needs proper definition. But there are a few other important words and terminologies that we need to get familiar with as beginners, as freshers. Now, these are the three words which are peril, risk, and hazard. We look at what these three things are because these words are very, very fundamental to the concept of insurance. Now, right now, when we look at peril, what is a peril? You may have heard, some of you are working in insurance companies, you may have heard what is a peril, what is this fire peril, flood peril, all these things you might have heard. Now, exactly if we want to define the word peril, it is simply nothing but an incident or event that causes loss. Simply put, whichever event or whichever incident leads to a loss, simply put, it is cause of loss. So a loss can happen because of fire, because of flood, because of an explosion, or because of a road accident, or because of an accidental fall, whichever way you call it, whatever is the cause of loss, that becomes the peril. So it's a very simple definition which you can remember. Then comes, now when you talk about insurance, most of the times many people as freshers, they presume that the perils can be stopped by insurance companies. Can we really stop? If there is rain, is there a way we can control the rain? No. It is just that as a client or as an insurance company, we can guide our clients to minimize the damage that is caused by flood or rain or explosion or fire. So we need to understand perils cannot be stopped in totality. It is the damage that can be minimized. And what actually the insurance company does is the insurance contract itself is a promise, right? It's a promise. It's an undertaking by the insurance company to pay to the client whatever is the compensation that needs to be made for a particular loss. So insurance company compensates for the losses. It is not like we can say, gee, some magic we can do and avoid the peril. No, a peril has happened. We can guide in damage minimization, and the insurer also compensates financially the extent to which the losses happen. Now, another important key element in peril is the compensation would be only for financial losses. Anything that needs to be paid as a claim in insurance has to be measured in rupees, in Indian rupees, in a financial context. We cannot pay for emotional losses. We cannot pay for some aesthetic losses, right? So those are things which will not be within the purview of insurance. We'll look at some examples to understand the difference. Now, here's an example. How do you understand financial loss? Let's say you have a pair of diamond earrings. Pair means two, right? Right ear, left ear. Now, maybe this was gifted by your mother, and so it is very, very sentimental to you. It's very close to your heart. You are emotionally attached to the gift. Now, the cost of these earrings as a pair is 2 lakhs. but you have insured it for 5 lakhs because it is very, very important and your mother has given sentimental value, emotional value. All this you are attaching and increasing the original value of 2 lakhs to 5 lakhs. But if it is stolen, what will the insurer pay? The insurer pay only 2 lakhs because we don't consider the emotional loss, we don't consider the sentimental losses, right? We cover exactly for the financial loss that arises by losing the earrings. Now, another example, if you see in the second one, you have a pair, right? Two earrings. Now, let's say one earring got stolen. The total value is 2 lakhs. One earring got stolen. So, one stolen means the other also you cannot use. Obviously, you can't wear one, right? So, you might say, no, no, this has become useful for me. So, you can ask the insurer to pay you 2 lakhs compensation. No. So, the financial loss, again, the concept is like whatever is lost out of two, one earring is lost. So the insurance company will pay you only 1 lakh. So this is the primary framework of insurance. What is a peril? Cause of loss. We cannot avoid a peril. We can minimize the damage, and the insurer pays financial compensation for the loss that is suffered. So like you saw, we already saw insured in the first example, insured will pay only 2 lakhs and not 5 lakhs. And in the second example, only for 1 earring, which is 1 lakh will be paid as compensation. Now the second word that we saw was risk. Risk means what? We already saw what is a peril. Peril is simply cause of loss. Risk means it increases the chances of a peril. Isn't it? So it's a very risky thing to go out on a rainy day because I may slip and fall. Right? So risk is the possibility of loss arising out of a peril. So it is very important to assess the risk as well when you talk about insurance, because that is how an insurance company will be able to decide whether this particular policy is worth what we call as underwriting. They do the underwriting based on the risk profile. So risk is, simply put, it is the possibility of loss arising out of a peril. So I don't want you to get overlapped with risk and peril. These are two completely different terminologies. So like in the example, a cyclone is a peril, but a cyclone over a sea does not cause loss. So if let's say the cyclone is a peril, clearly it can lead to loss. But if the cyclone happens mid-sea, there may not be any property for you to even get damaged. So in which case, if a cyclone happens within the city, then it is risky. So the possibility of loss, if the cyclone happens within the city, definitely property is going to get damaged. So the city is a risk, and perhaps the sea is not a risk. Like this, you analyze the possibility of a loss arising out of a peril. Now, similarly, hazard. The third word was hazard. Hazard is something that increases this possibility. So, anyway, we know that risk is a possibility of loss. Now, the hazard is something that increases or decreases the risk itself. Again, this is the third clear element or terminology which needs to be clearly understood as a separate concept. So physical hazard, moral hazard. Let's say if somebody is smoking, then definitely he has high physical hazard. So smoking itself can be very risky, but at the same time, if he's a chain smoker, then it is a high hazard, right? Because it increases the probability of a loss. So this is how I want you to understand the clear-cut distinction between risk, peril, and hazard. Most of the times, peril and risk are used interchangeably, right? In other than insurance language, if you see, you will notice that mostly people use peril and risk mostly interchangeably. But no, that is for the layman's language. Right now, we are very clear that peril has a different definition and risk has a very, very different definition. So in this picture, if you see that is there on top, the peril is accidental fall, cause of loss, right? He fell down. That is the cause of loss. The risk is that the person who is walking on a kind of a single rope. Now the hazard is because rather I would say the risk is that the person himself is exposed to the loss, but the hazard is that he is walking on the rope, which makes it a very high possibility of the person tripping and falling down. So like this, there are any number of examples that I want you to clearly see the distinction between risk, peril, and hazard. Now we'll stick on to the word risk, which is the very, very basic element of insurance. All that is covered in the case of insurance is about handling risks, right? How do we handle risks? So before even handling risks, it's important to categorize and understand the types of risks. So the category one is called catastrophic risk, which means what? Simply put, more than one property is affected by a peril. So when you say catastrophe, it is a big loss. That means multiple properties. Let's say Mumbai floods. So Mumbai, if flood happens, the entire city, so many, cars, vehicles, properties, houses, industries, offices, all these get damaged because of the huge floods. So it is a catastrophic loss. More than one property is getting affected. Now, the second categorization is financial risks and non-financial risks. Like we already saw, the property should be able to be measured in value of money. If you have, let's say, a Picasso painting with you, which does not have an intrinsic value, it is, let's say, it has a lot of emotional value and all, we don't consider. For that matter, even if you have a disease, the medical bill, yes, it's a financial risk, but there's a lot of pain and suffering that you need to undergo while taking the treatment. But this is not a financial risk, right? This is pain and suffering cannot be quantified in terms of money. So clearly, distinction between financial and non-financial means you are able to measure the property or the damage in terms of money with a certain basis of calculation. The third categorization is dynamic and static. So dynamic means today we are saying everything around us is changing at what swift pace. It can be the technology that is changing, it can be the political scenario, the economic condition, the natural condition. Everything is changing and it poses a lot of risk, like how we saw the pandemic itself, right? We saw the corona happening because of a dynamic risk. Nobody expected, and the kind of havoc it created across the world. It is a dynamic risk. Everything changes so quickly. That is what it means by dynamic. Static means nothing changes, right? It is like a stay put hardcore risk. Like let's say somebody is dishonest, right? In an employees, 10 employees are there in an office, one person is a person who always does fraud. This is a static risk. This doesn't change because of anything. So drastically, it does not change. So very, very specific and static risk that leads to a loss. And then the third categorization is very important again to insurance. This is, dividing the risk into pure risk and speculative risk. Now, whenever we talk about risk, we already saw risk is a possibility of loss arising out of a peril. That's what we saw, right? Risk should be always attached to the possibility of a loss. That is when it is called a risk. Simply, if floods is happening over the mid-sea, like we saw in the example, there is no risk there. But if the flood happens within the city, there is every chance of risk. Possibility of loss is very high. So pure risk is something where it is beyond the control of the people or the person who's taking the insurance, but there will always be a loss that happens that can be anticipated. But in the case of speculative risk, like in the case of, let's say, somebody playing a video game or a betting or a casino, where you have the risk of losing money, you also have the risk of gaining money, right? If you play well, you may win. In a bet or in a game or in a match, there is a risk that let's say you're putting a bet of 1 crore that India should win today. There is a risk of losing money, but there is also a chance if India wins, you will win that money. So this is speculation, right? So for your understanding, in insurance, we are restricting ourselves only to pure risk. We don't cover speculative risk in insurance. This is something you need to understand as a beginner. Now, the fourth categorization is fundamental and particular risk. This is also similar somewhat to your catastrophic list. So, fundamental means again more than one person getting affected. It can be earthquake, it can be landslide, all act of God perils where it sweeps the entire locality or entire state or entire place where many people get lost. So, fundamental risk. Particular is one person. Let's say one person is riding a motor vehicle and he meets with an accident, he gets injured. So this is a particular risk. All these classification of risks are very important from insurance point of view, because only when the insurance company understands what type of risk it is, then only they can do the underwriting properly. They can accept the proposal in the best possible way. So having seen some categorization of risks, now we look at some types of hazards, right? We already saw hazards also. So physical hazard, moral hazard, moral hazard. Now physical hazard means it is the physical attribute of a property. Right? If you have a wooden table, the wooden table is more susceptible to fire damage. Wood can catch fire easily, right? If you have an iron table at home, then the physical hazard is less because iron does not catch fire easily. If a place is storing petrol in a factory, then petrol is highly inflammable. It catches fire very easily. So, storing petrol is a high physical hazard. But let's say you have enough water buckets and sand buckets to extinguish a fire, then it is a good physical risk attribute, because the chances of fire and extinguishing it is very, very high. So physical hazard, so what we saw as hazard is increases the possibility of loss. So physical hazards can be any attribute of the physical matter or physical subject matter which increases the possibility of loss. Moral hazard is a characteristic of the person, somebody who's a fraudster, somebody who engages in a lot of gamble or cheating or many things. He can be a criminal, he can be somebody who causes harm to somebody, can be a thief, it can be a robber who burgles away or robs away things, right? These are all moral hazards. There can also be sometimes some insureds who have regular losses in their policies. So every year they take losses. That means what? Something wrong with their moral hazard. The characteristic of the person is such that they take insurance only to make claims. So like this, the insurance company will also assess the moral hazard. Then comes moral hazard. Moral hazard is a situation or a platform or the circumstance in which the peril can occur or the risk will happen. So quite possible, let's say, in a factory, the wiring and all the electrical apparatus is not maintained well, right? This is because of the lethargy of the workmen. So this is a moral hazard. People are not equipped, they are not trained, they are very careless, they are negligent, then it is a high moral hazard. Similarly, in a medical hospital, let's say, the accounting system is not so good, so anybody can pull out any fake bills and make claims. This is a very, very high moral hazard, right? So the circumstance or the situation that leads people to make or create losses is called a moral hazard. So right now, since we've understood some basics of risk, peril, and hazard, now we'll move to what is the next element, which is called risk management. We saw various categories of risk. Now, there are four methods in which the risk is managed by the insurance company or even by the clients. Now, the first thing is avoid the risk. So some people, if like the example is given, if they feel that they have high chance of falling down from a two-wheeler, they will simply avoid riding a two-wheeler. Nowadays, to our own children, we don't even give them two-wheelers. Straight away, we buy them cars. Because the roads are not good, the safety is not there, so much traffic congestion is there. So we want to avoid the risk of falling down from a two-wheeler. This is called avoidance. Then comes reduce the risk. So wearing a helmet. So let's say you have decided to travel by a two-wheeler, but again you want to wear a helmet to reduce the possibility of loss or reduce the risk. So this is called wearing a helmet is an example for reducing the risk. Retain the risk. Some people feel okay, after all, if I fall from the two-wheeler, what is there? I may get slight injuries. It's okay, so I will just ride my two-wheeler, and they retain the risk, right? And some people take the option of transferring the risk. So some people go for vehicle insurance or they go for two-wheeler insurance, personal accident insurance. In case they fall from a two-wheeler, they keep an insurance policy as a backup for any medical expense or any injuries or anything that may happen. So the main aspect in these four methods is the transfer of risk, which we deal more commonly in insurance. So the transfer of risk happens from the client to the insurance company. Now we saw reducing risk, like we saw the example of wearing a helmet. There are some more very interesting examples for risk reduction. In industries, if you see, there's something called a separation. If you see a factory's huge premises, right? So one of the simple ways to reduce the risk or reduce the possibility of losses, they create the layout in such a way that all the stocks and inventories are not kept in one bulk in one place. They are scattered across the factory. So that even in one place some fire catches, they can put out the fire easily before the entire fire destroys the entire stocks or inventory. So separation is one risk reduction tool. Then comes duplication. So keeping a backup, like standby machinery, some industries may have, or let's say data is very important. You keep a backup through a server. Like this, you want to duplicate and keep a backup for your important property. So in that case also you can reduce your risk. Diversification is the de-risking. Typically, if you see in business, a lot of people they engage in multiple products so that if one product fails, another product might get them profits. So this is called diversification, where you spread the risk across areas which may not affect you equally, so that it is de-risked, and in some segment you may make a profit and run your business. Now, like I said, for insurance, we are more concerned about transfer. Now, what are the risks that can be transferred? We'll look at this in this beginner's content. Now, damage to property and materials is very simple to understand. Anything that can happen to your property, it can be a house, it can be a school, it can be a vehicle, it can be a factory, it can be your electronic gadgets or mobile phone, whatever property you have, you can cover, you can transfer the risk of damage to this property by a set of perils. It can be natural perils, it can be specified perils. All these things will be mentioned in the insurance policy. But right now, I want you to understand the risk that can be transferred is the risk of damage to property and the risk of consequential loss. So direct impact to property is one thing that can happen. Let's say the factory got burnt by fire. It is a direct damage to property. But because the factory got burnt out, your business also stops. It is a consequential loss. You can't run your business because your factory is burnt out. So it is consequent to damage to property. Now here it is a consequential loss. This also can be transferred to the insurance company. Now, who transfers the risk? Risk management is a function of business but applies to individuals also. So, generally, who transfers it need not be just business houses, corporates, commercial firms, industries, factories, schools, it can also be individuals for our own house property, for our own individual life, for our family's life, individual health. So, it can be corporate business, it can be individuals also who can transfer their risk to the insurance company. So an individual can transfer the risk on their life or properties that they are buying. Now, like we saw, the method of the most significant and common method of transferring the risk is insurance. This is what we saw as an example. But there are many other tools that can be followed for risk transfer. These are just examples for you for your wider academic interest. But right now we will stick only with insurance. But I want you to, look at some of these examples which are not in the, as a part of insurance, but I want you to understand some of these keywords. Indemnity agreements. Right? I mean, when somebody takes a loan, he will take a bond, isn't it? So a promissory note or a guarantee, right? Like this. So this is all risk transfer, where the person who's lending the loan takes an indemnity bond or a guarantee from a third person that in case the first person does not return the loan, the other person will return the loan. So this is again another concept of risk transfer. Similarly, hedging. Hedging is again very common in the stock market, where you offset the financial transaction made to offset the loss of another transaction. So you enter into a new transaction to reduce the loss of a separate transaction. This is called hedging. There can be stock price that may go up and down. There can be foreign currency that can go up and down. For all this, you enter into a separate hedging contract and lock the price of the stock or the foreign exchange. Right. So one transaction to transfer the risk of another transaction. This is typically an example of hedging. Now, there are very many new tools in the industry from international practice that is coming into insurance as well, which is a very, very important and very interesting risk transfer tool, which is called alternative risk transfer, ART. Right. So I can just give you an example. I may not be able to go in full depth into this, but so what we said we can transfer either the damage to the goods or the consequential loss. But in the case of ART, whether or not the crop, take the example of crop insurance, there is a rainfall that will be covered as a risk. If there is rainfall, you get good crop. If there is no rainfall, you don't get good crop. But in the case of ART, even though there is no rainfall, but if the policy is issued in such a way that if there is no minimum rainfall, we will pay you compensation. This is another risk transfer tool. The insurance company decides to pay compensation. So what the insured does is they may take the claim and use some pump sets and other things to still irrigate their crops. But rain did not happen, but they're using some other mechanism to grow their crops. The insurance company is not concerned with that. They will anyway pay. So this is a very unique kind of risk transfer, which is called ART. Right now, we will also look at some of the basic concept of insurance. So in the case of insurance, the insurer is the person who insures the property, insurance company. The insured pays premium to the insurer. The insurer promises to make good the loss or compensate for the loss in case something happens. The loss should happen because of a set of insured perils that will be mentioned in the policy document. So this is a clear-cut concept of insurance. So the important aspect is, we call insurance as a definition. If you see, we say it is a pooling of risk, sharing of risk, spreading of risk. All these are very common terminologies. The risk is getting pooled, the risk is getting spread across many people, right? The risk is getting shared across many people. So why do we do this? Because when it is one person, the uncertainty is very high. If let's say I have a house, I don't know, the chances of whether a fire accident will happen will be 50-50. But when I go into a group of people who have houses, but not all will face loss, not all will face fire accident, then the uncertainty converts into a certainty. We will know that out of 100 houses, maybe 10 houses will get damaged. But we have the pooling of premium from these 1,000 houses or 100 houses. The concept of insurance itself is to constantly see how to convert the uncertainty into a certainty when the group of people, the sharing happens with the group of people. So this becomes a foundation of insurance. Insurance premiums are collected from many and paid to the few who face the loss. So just to summarize what we spoke in the previous slide, how insurance works. There is an insurance industry, there is a concept of pooling. Like I said, people exposed to similar risks are brought together. When we say similar risk, it can be all the people who own vehicles can come together, all the people who own residential houses will come together. Like this, we pool them and we give them one common product, which is either fire insurance or motor insurance. Like this, they are brought together and pooled. And then the insurance company acts as an intermediary to manage this pool of premium. Then, with the mutual consent of the group members, the loss that happens to a few people in that group is compensated as a claim. It can be anybody, isn't it? So the risk is for all, but the loss happens only to a few. So those few people will get a compensation from the insurance company from the premium that has been pooled from all the people who are brought into the pool. So this is the fundamental concept of insurance. So, like I said, when you say similar risks, fire insurance is separate. All house owners come together. Marine insurance is separate. All ship owners come together. So, similar risks is something that's very important. That is how the type of policy is also decided by the insurance company. So, now having seen the sharing concept and the basic concepts of insurance and some basic terminologies, I want to close the session with some of the basic different classes of business. So when you say insurance, especially across the world also, there's life insurance, there is non-life insurance. Life is a person's life is being covered. Non-life is all other things other than person's life. It can be property, it can be goods, it can be vehicles, it can be buildings, anything that we saw. So within the non-life also, there are three main categories that are basically understood: fire, marine, and miscellaneous. So all your insurance policies fall within these three buckets. So fire is straight, right? You cover fire insurance policy, you give marine insurance. Within marine also you have marine cargo, which is the goods. Marine means transit risk. Fire means within the factory, if something happens, it is covered. Marine means the stocks are being transferred from one location to another. During the transit, if something happens, marine is issued. Miscellaneous is again a bundle of many insurance products. Right? It can be motor, it can be liability insurance, health insurance, or even burglar insurance, and it goes on. I think today in the market we have more than 350 products that are being sold by insurance companies. So this is again a detailed breakup, like we saw life and non-life. So life covers the lives of human beings. Non-life covers objects or subject matter or property. Within non-life, fire, marine, miscellaneous we saw. Within fire, you have fire risk, you have natural perils like earthquake, flood, landslide. All these are also covered. Explosion is also covered in the fire insurance. Now within marine, like I said, this is a transportation risk. When the goods are transited from one place to another, whatever damage happens, that is what is covered. So marine again breaks down into cargo, which is the goods that are being transported from one place to another, and the vessel, the ship or the lorry, which transfers, not lorry, but the ship basically. It's called hull insurance. So whenever you have a sea consignment, so the ship will transit the goods from one port to another. So you can also take hull insurance under marine. Now miscellaneous insurance, we have, like I said, a whole list of products. The most common ones are motor, breakdown risk for machinery, personal accident, health insurance, then dishonesty of employees, liability. Like this, there's a whole lot of bundle of policies under the miscellaneous insurance. So right now, why is insurance required? Now that we've seen the terminologies and the concept and the types of insurance, we just want to close by seeing why is insurance required? Today, we know that the insurance industry, the general insurance alone, did 2.2 lakh crores of premium last financial year, 2021-22. It's a huge industry. Why is insurance required for any country or any business, right? It is for business continuity. Only when a property owner or a factory owner or a school or a hotel, whatever is his business, he takes insurance to ensure that he is completely covered for all kinds of risks and losses, so that in case there's a loss that happens, he gets a claim, he gets compensated for it, and he can run his business continuously. Right? So this is very important even at the national level, where the national development also happens only when your industry is flourishing. So insurance actually supports the business continuity activity of the country. Then credit. So a lot of people, they take credit insurance, they, sell goods on credit. They're able to expand their business by getting into a lot of risk taking abilities. So once you have insurance, you can freely move and expand your risk taking ability. So expansion of business, not just continuity, but expansion of business also happens because of insurance. And the third is, of course, for any natural calamity, you get a compensation, which is very important, because nowadays floods happen so common, 3 times, 4 times in a year. So whenever a flood happens, then you get the compensation from the insurance company. This is a very, very useful uh, initiative, right? So insurance also provides protection against losses due to convulsions of nature. So we saw the business significance of insurance. Now we look at the credit. So whenever somebody does business on credit, there is a whole credit risk insurance that is available. If the business has to thrive, they need to lend more loans and sell on credit. So, but they can take an insurance also, which gives them enough ample scope to expand their business. And there's also very, very common, very important aspect of purpose of insurance is liability. So many professionals or even industries, they face a lot of liabilities in today's world. It can be because of their professional services. It can be because of something, some pollution that happens from their factory, or it can be because of wrong or faulty product that they manufacture. Any number of liabilities can happen because of the business. So all these also, if they take insurance, then they have a good scope to increase their business. And of course, insurance plays a huge role in the economic development of a country. Like we saw already, the industrial growth will happen once there is business continuity. And the industries depend on insurance to manage their risks, especially, nature, the flood, the risks which are beyond the control of the industry owners. So that way they can manage their risks. So insurance thus facilitates economic development in a country. Also, the other aspect of economic development is quick settlement of claims, right? Very, very important when insurance companies, most of the times, the regulator that we have, IRDA, they insist that the claim settlement ratio should be above 90%, which means the client should get their claims on time and they should be able to continue their business. So that also plays a huge role in economic development. And the premium, whatever the policy holders are investing in, paying the premium, these premiums are in turn invested by insurance companies in government projects, in infrastructure, fueling the economic growth of the country. So if you see the role of insurance, it is not just at the individual level, it is at the political level, national level, economic level. At various levels, the insurance industry plays a huge role in stabilizing a country. Also, there is a angle of social security. Many people who are poor, who are in the downtrodden areas, nowadays you are seeing government offers free scheme to them, the medical and the house insurance at a very, very nominal premium, right? So this is again a social security. So in case something happens, mostly the people who live in the villages, they are really exposed to the risk of poor health or poor sanitation, or even the property that can just get washed away because of a serious flood. So immediately the government also comes in to pay them compensation. So the government directs insurers to provide rural insurance in many ways. So this is again, it acts like a social security in India. So this is the end of this very, very introductory free webinar. In case you find it interesting and you want to get into the depth of the topics, and there are very many interesting concepts that get further dip down, like there are principles of insurance, there are contractual legal framework, there's a financial framework for insurance, there's a marketing side. So all these things we deal with in our detailed 6-hour course, which is called Insurance for Beginners. In case you found this free webinar interesting, you can sign up for the full-fledged course of 6 hours and you can come in and learn. And it will be a very, very good exposure for you as a beginner to establish yourself in the insurance industry. So just to summarize, we saw peril, we saw risk and hazard, we saw the various types of risks, and we also saw the various methods of handling the risk, which is avoiding, reduction, retention, and transfer. And we also saw the various categorization of life and non-life, and also we saw the broad classification of fire, marine, miscellaneous, and the need for insurance at a national level and at the business level, right? It is needed for business continuity, it is needed for economic development, and also for the social security. So right now, I think we will close the session right now here. Thank you so much for joining, and we will see you on the other side in case you enroll for the detailed course. All the training program and course information, you will find it on our website, which is www.iracoaching.com. And if you found this free webinar useful, every Friday 5 p.m. we will run a free webinar. There are many interesting topics that will come. You can make use of them. You can also let your friends know about the programs. And right now, this, in case you want to go through this video again, you will find it on our YouTube channel, which is IRA Coaching Official. You can always go back there and revise and rehearse the content in case you want to do so. So thank you so much for joining, and we'll close here. Thank you. See you again in the next.